Good evening to all the participants, and first of all, thank you all for giving your time to JM Financial to hear us out on our webinar for the month, where we try to address the path for the markets for the month of December. We will be taking you through how the positions are being set in the futures in the options market for the month of December, how the various participants in the markets have placed themselves to trade for month of December, where the highest open interest stands, which are the sectors you should be looking for on the positive side, or sectors which are vulnerable for some profit booking. And lastly, we always make it a point to help you out with the best option strategy, where you can strategize your entire trading plan for the month using options. So just a small, what we said last month was that Nifty should be positive, but we devised a range bound strategy. And if you take a look at how our strategy fared for the last month, we stuck to the plan for the strategy, and if you would have followed us, I think you should have made easily a return of the targeted returns which we had addressed in our webinar. So first of all, briefly to take you about how we look at the index. If you look at the November series, November was a very healthy traction for the market. There was good momentum throughout the month, leaving aside the last 4 or 5 trading sessions prior to the expiry. And in the last couple of days, in fact, today we had a scenario where Nifty almost has registered new highs, that is all-time high levels, as we step into the month of December. The volatility index, which we call as India VIX, did show an intent of a pickup a few trading sessions back, but it's back at around 11.2, and the setup indicates that things are normal. There is no concern, as the VIX indicates for the month of December. Now, when we talk about rollovers, rollovers exactly means that the positions, how the traders have positioned from the November series to the December month, how the positions are carried forward. Normally, the rollovers as per the last 3-month averages stand around 80%. This time it was around 69%. So the rollovers are a bit lower than what they should be, than what the normal numbers are. At all-time high levels, if you are seeing less aggression in longs being taken forward to the next month, it is a slight concern, which shows that at the all-time high levels, there is a slight kind of a shyness or some bit of a scare in going aggressively long in the market. That's what the futures and options rollover have to suggest for the month of December. So this is broadly a roadmap as to how the positioning has been on a broader terms. And if you look at the view, somewhere 26,300 is a pivotal zone for the Nifty. Now, what I mean by pivotal is that if you look at the price action in the market, we also have put a chart below for you of the Nifty. That's the daily chart for Nifty. There have been a couple of instances lately where 26,250, 26,300 basis spot Nifty has been a level where there has been some degree of resilience for the market, and there has been some little corrective action which has played out. So really how strong 26,300 plays out to be would be a question mark. But since we are dealing with a pivotal level for the market, it's an important trigger. If it breaks past these levels and sustains above it, you can easily look forward for an upside of 300 to 400 points from the current levels. And if the momentum does fade out from the pivotal zone, then again we are staring at some slight corrective action where markets may again get below the levels of 26,000. So which way the direction will be, we strictly adopt a level-based approach. So let the prices decide, and we not anticipate in advance which way the market would go. This is the call which we are taking for the month of December. So first of all, the broader rollovers is suggesting a bit of a caution for Nifty. Bank Nifty rollovers too suggest a bit of a caution because only 70% of the positions which are probably long bets have been rolled considering the 3-month average readings of 79%. So even Bank Nifty, which is almost at its lifetime highs, almost at the zone where it is about to secure a psychological level of 60,000. That's the point where rollovers are slightly going easy. There is a slight concern in going aggressively long considering the strong run-up which the Bank Nifty has had in the last couple of months. Now, how are the options data placed for the Nifty index? Well, the put writers are at 26,000. Now, 26,000 is a pretty close level if you see where we are trading today. We are just around 250-300 points from where the support has been defined by the put writers. If you roughly add the current premiums where the puts have been written, roughly you may conclude that somewhere around 25,800 is the zone which would be a massive support for the market as it currently stands. So till we are about 25,800, I think the put writers will hang on. Put writers at 26,000 will hang on to their writing bets. If there is if the levels of 25,800 would break, that is the first level of alert or a caution that things are not going as the markets suggests, and we then would review it and look for a U-turn or a reversal of trend in the market. But that would be only subject to market getting below 2,500, which, as the current data suggests, doesn't look a high probability. We are in a positive stance, we are in a sweet zone, and we are in a position where markets are staring at a positive breakout of 25,300. So keeping the positive view intact, if we do see the positive momentum picking forward, the call writers are slowly moving to higher strikes of 26,700, even 27,000. These are the couple of strikes where call writers are slowly spreading their writing bets. This, you can also say, is an anticipation of the possible upside of the targets which the traders are looking forward to. Now, if you look at the seasonality aspect for December, I think if you take the last 10 years of data, 6 out of 10 instances, that's almost 60% probability, has been that Nifty has closed positive with an average return of 1.6% for the month of December. So there is a positive rip-off always in the month of December on a totality basis. And with this entire broader perspective in mind, we have levels which we have defined for the month of December. Support is at 25,800. And in case 26,300 is taken off, we are looking at potential targets of 26,450 to 26,700 on the upside. So here, first of all, things which I mentioned just a couple of minutes back, we spoke about the rollovers, a cautious outlook for the Nifty with fewer positions being carried forward. Positions are a bit light than comfort. If you look at Bank Nifty, the rollovers are 70% compared to the 79% average rolls last month. And it is just showing that although Bank Nifty is a stronger index among the Nifty and the Bank Nifty, at all-time high levels, there is some bit of cautiousness, or around 60,000 or 60,200, Bank Nifty may be prone to some degree of profit booking as we move into the month of December. So Bank Nifty is a bit overstretched. There is a bank policy due on 5th of December. You need to be a bit careful because probably this is the fag end of the rally if you are a short-term trader, and Bank Nifty might be prone to profit booking once it tests or just manages to cross the psychological level of 60,000 for the month of December. Market-wide rollovers suggest that it's overall a stable market. But again, if you look at the broader market, it's completely a stock-specific dominated market, and you have to be very specific and cherry pick the stocks, which we will help you out in your journey for the month of December as to which stocks or sectors should look good as you move ahead. So I'll give you a broad outlook based on the price action and rollovers as to which sectors you should be watching on the buying side or the long side. So initially the rollovers was a bit stable for the pharma pack, but as the December series kicked in, the last 3 days has seen a strong traction, a price momentum in the pharma names. And I think the way the charts are placed, most of the pharma stocks are have defined their supports very clearly and are in the process of now getting into the momentum zone. So pharma is one of the sectors you can look forward to. IT is another space which has been more subdued in the last 3 months. There were a lot of short bets in the system in IT, but the positive or the silver lining is that many IT names are suggestive of a short-term bottom being in place. There has been demand in some certain IT names at the lower end, and slowly and steadily the traction is picking up in IT names as they set themselves up for a possible breakout of the upside end of the range. So IT can be the other possible sector pick which one can have on their radar, although there might be not very strong momentum, but pharma and IT are the two counters or sectors where there can be steady gains in case the index goes on a choppy footing for the month of December. And metals has been the darling of the markets last 3 months. They have been an absolute bull run in the metals pack, and I believe the rub-off effect can continue in most of the metals sector. Although there has been slight corrective action in some metal names, I think it's more volatile, and buying on dips or the slight dip which had been offered lately in metals pack can be used as a trading bet for a short-term recovery in the metal names. So keep a watch on these three sectors on the positive side. And if you ask me as to which sectors can be more vulnerable to profit booking, as I mentioned, large banking and financial services names. They have had a spectacular run-up in the last couple of months, especially the PSU banking names. So in case there is some bit of a profit booking spree once Bank Nifty touches 60,000 plus, then large banking names, the like of an SBI, HDFC Bank, and so these are the names which might be slightly vulnerable to temporary profit booking. So if you are micro timing or are concerned, then banking might be the sector which can see a temporary profit booking spree, which you need to be careful about. Now, the next slide, I will take you as to how the FIIs are positioned in the Indian markets. On the left-hand side, as I always show you in all my monthly presentations, we look at the cash positioning of the FIIs, and on the right-hand side, we are looking at how the F&O trades are positioned in terms of the open interest built up by the FIIs. So clearly, if you look at the trend in last 3 months, there was strong selling intent in the cash market from the FIIs. On an average, you may conclude that 40,000 odd crores was the net sales number which came out for July, August and September in the cash market. But surprisingly, this selling spree from the FIIs has kind of gone cold. October month has been more of a revival. There has been selling of only 2,000 crore, which is significantly lower than what the average sell numbers have been. So you can see this as a silver lining. Now, November, December numbers, if they do come in the green, that would be a positive traction that FIIs are getting back in the Indian market in the cash segment. So we will keep you updated on the numbers. But one positive thing till October was that the selling spree has eased, at least in the cash market. If you were to look at the futures or the index futures, where we talk about how Nifty, Bank Nifty, financial services or the mid-cap index, how the FIIs are placed there, clearly for the month of October, they bought around 4,960 crores on totality. So there has been an improvement in the FII participation in terms of long bets, because if you look at the prior 4 or 5 months, there have been continuous selling numbers. The long short ratio, which we keenly track, was in fact, if you recollect, around 12 to 14% in the prior months. As it currently stands, it is around 17-18%. So it does mean that slowly and steadily the long short ratio is improving. The longs are gradually getting back in the system from the FIIs, and we will keep you updated on how the numbers improve. If the numbers does get about 25-30%, you can be rest assured that the numbers will improve going ahead. So just the initial stages of improvement, but at least the positive thing is that the selling pressure has abated. going by the last 3 months of data points. Coming to the next slide, if you look, we spoke about how the FIs are positioned. We spoke about the key levels which you need to watch. Supports would be 25,700 and 25,350. Now 25,350 is the worst case scenario. If 75,700 were to break, we do not feel 25,700 should breach for December, but levels which you need to follow are these two levels. Resistance 26,300, we are almost there. Next week would be crucial as to whether Nifty breaks 26,300 or not. If it breaks, expect the momentum or the pace in the index to catch up fast, where 26,650 can be the potential upside targets for the month of December. Now, there are a lot of events which you need to note for the month of December, because these are the trigger points for the market. First of all, there is a lot of talks in the market about the India-US tariffs. High tariffs, as high as 45% plus, are what we are currently bearing. And there have been a round of talks since last month that there can be an ease in these numbers, but really there has been no breakthrough as of yet. So the market is very keen and tracking this, but when will this unfold? Which day will it happen? Or will this happen or not? This is where there is not much clarity, but speculation is rife that there might be some bit of an ease in tariff, and that speculation kind of fuels the market from time to time. So unless and until you have the scenario kind of unfolding, we really would not like to take a comment as to how it would play out. But in case there is an ease in numbers of the tariffs, then you can expect a strong round of momentum uptick in the market, where easily targets of 26,650, which we speak of, can be achieved just in a matter of days. Second will be the FII flows. Too early for the flows to improve, but the positive takeaway is that selling numbers have abated and slowly green shoots are emerging. That's the positive take there. RBI policy meet on 5th and 6th of December for the banks would be another attraction for the markets. The markets are very keen that there might be rate cuts in the making. There's some media speculating too that there might be rate cuts, and if it does happen, it will be a positive booster for short-term trading in the banking space. Already the momentum in banking, which we see in the last few days of trading, is built that on the fact that there might be some rate cuts. And also Fed meet on 9th and 10th of December also suggests there might be rate cuts which are supportive, and the markets are already marching ahead on this thought process. Lastly, global tensions also would be what you need to keenly observe or keep a tab on, because the Russia-Ukraine deal is what is where the weightage has been given by the market participants. If there is some breakthrough or more clarity on those lines, then you can expect some degree of volatility or clarity for the markets for the month of December. So these 5 events are the key triggers which you need to keenly follow. As currently you may see, the markets already are factoring that these 5 events will be on the positive side, and hence you have a positive rubber for traction picking up in the market. Now, I have given you a broad level for the month of December. I have shared you how the positioning is for the month of December. It is a positive view, which levels you need to take forward, which sectors you should be looking at. And lastly, as always, we always make it a point to give you the best strategy if you are a derivatives trader, which is the best option strategy for this particular month. So this month we have devised a ratio put spread strategy. This strategy is primarily moderately bearish strategy, but it works in a moderately bullish scenario also. To make it more easy for you, what we are doing exactly is that we are recommending you to buy one lot of 25,700 monthly Nifty put, which was roughly closed around 94 today, and we would recommend you to sell 2 lots of 25,600 put of a lower strike. This is 2 lots at the price of 80 as it closed today. So what we are doing is that our strategy is moderately bearish in the way we have constructed it. But if you look at the payoff table for the month of December, we are getting a cover all the way till 25,400 on the lower end. Markets even if it breaks 25,700, we are in a sweet spot, because 25,500, 550 is the sweet spot for the strategy where you can get maximum returns in the strategy which we have set. In case this strategy doesn't go down, it goes up, the market stage a breakout, you have nothing to worry because there is no upside risk at all in the strategy. You have a fixed inflow which you derive of roughly around 70 to 80 points, and that is what you can get in, even if the markets were to have a breakthrough rally from the current levels about 26,300. The risk will be that if the market falls from here, you might see a temporary hit in terms of the M2M margins, which you may take a hit on. But worst case scenario is if the December series drags below the levels of 25,400, then that pain point for the strategy starts. That's the point where an unlimited loss scenario can unfold. So this worst case stop loss, if you are trading on this strategy, would be below 25,400 basis spot Nifty. So this is the best way to approach the market. I think we are benefiting out of three situations: a bullish situation where we get the inflow, a moderately bearish situation where 25,550 is the sweet spot for the strategy, and even a slightly bearish scenario would work in our favor. The only scenario which would work against us is in case we have a sharp fall of almost around 1,000 points from the current level, then the strategy goes for a toss, which the probability if we weigh is highly low. So this is the best way to approach using options to strategize for the month of Nifty, where easily you can look for the targeted returns which we have presented in our payoff. So with this entire background for the month of December, the sectors which we feel are good, the strategy which we feel is apt for the month of December, I would like to conclude my short presentation for you and wishing you all the best for the month of December, that you may have a profitable month. And with that, I wind up or conclude my part and would open this forum for the Q&A session. Thank you.
How to analyze and know about future positions and rollover.
So look, what happens is every month we do send you a rollovers report on the day of the expiry. So what we normally look at is what the rollover numbers currently is, what was the rollover in the prior month, and how the average 3-month rollovers are. So we need these three set of data when you compare the rollover numbers. Now, just numbers, if we were to look at, we would not get a proper idea, because rollovers just say that what is the trading interest in the market, how aggressive are the positioning for the next month. So for that, you have to correlate the price action for the past month or the month which has gone by to just get a broader idea as to how the market has been faring. So for example, if the markets have been positive and the rollovers are high or better than the averages, it means that positive bets from the prior month have been taken over to the next month. If, let's say, the prior month was negative or there was a sharp fall in the market and the rollover numbers are significantly low, it would mean that suddenly, although the market was weak last month, traders are shying away from taking their short bets for the next month, which means that the downside for the market can be limited and people are looking for a recovery or a smart bounce back scenario because short positions have been covered in the prior month. So this is how rollovers have to be read for stocks or for the index. The pieces of data which you need are the current month, the prior month, and the averages of the last 3 months along with the price action, and then you get to form a view as to how the market may possibly fare for the coming month. So this is how rollover analysis is done.
How to predict movement of Nifty on a daily basis.
See, we can have a webinar exclusively for this, but some pointers which I would like to give you if you are tracking Nifty for daily basis is that first of all, you need to check our reports. We do a lot of research for you post markets. We spend a lot of time to come out with short narratives for you as to how the positioning has been before the day starts. But some pointers which you need to see before the day start is how the FIIs traded yesterday in the market, whether they were long or short. NSE today is giving you out this data. We are presenting and making life simpler for you by our one-pager reports. So have a look at the reports as to whether the numbers from FIIs yesterday had been buy or sell in index futures. As simple as that. If it's a buy, you're positioning your trades on the buy side. If it's a sell, then be a bit cautious and try to look to short markets or look for exit opportunities if case you are long on an intraday fund. So this is the very first way you approach the market. Look what the FIs are doing. Second, you need to understand a bit of technical analysis. Some short-term moving averages which we use is a 9 and a 21-day moving average. If the prices are above this moving average, it means the momentum is positive. If they are below this moving average, it means the momentum is slowly fading off. As simple as that. Third, look at where the highest open interest is in the options data. So right now for a daily trader, you have to look at the weekly options data and see where the highest open interest is in puts or calls. Wherever the highest open interest is in puts, that's your support, and where the highest open interest is in calls. So accordingly, you get a band where you are trading with. Things become much more simpler and a bit of technical analytics. This is how the broad framework is when you start your intraday trading journey.
How important is entry and exit point?
See, entry and exits are very important, especially if you're trading in futures and options. You need to time the market. See, because if you do not have that skill set, then you need to brush up your skills, because futures is a leverage business and options is a time-based business where again leverage is what you count on. So if you do not have the timing skills, and for timing you need a good understanding of technical analytic tools, I think you should brush up your skills there, because if you time it wrong, you can go on the wrong side of the market, and leveraging, because we are trading in futures, may really take you out in just one or two trades. So timing is the key whenever you are trading in futures. When to enter, when to exit. You cannot think twice. Exits have to be defined whenever you take an entry. That is the rule 1 of trading in futures. And once the trade goes in your favor, revising your stops or trailing your stops is the key to success.
Which is the best monthly strategy to make decent 2% profit with combination of buy and sell?
So, every webinar, we try to address you the best strategies. So whenever you devise a strategy, you need to have a view. Without a view, a strategy cannot be built. And really a strategy would just give you a scenario analysis as to what will be your maximum profit, what will be your maximum loss, and you are covered because you know in advance your game plan. But making a view is very important, and this is where we come into the picture. In research, we will define the risk reward for you. We will give you the view for the month and accordingly set the best case scenario strategies for you. But if you want a blueprint as to one single strategy which you want to run month on month, I think nothing is best than the iron condor strategy, where you devise a box or a range by selling calls and puts, and then you buy deep out of the money calls and puts. So basically it's more of a theta depreciation game. You define the range, and if the market stays in the range which you anticipate, you make the targeted returns. But markets always doesn't work in the same way as you want. Out of 6 or 7 times in a year, you may be right in this strategy. So out of you can say 10 trades, the strike or the probability of this strategy going right is almost 6 to 7. That is 60 to 70%, and that's a pretty good ratio to work with. So I think iron condor is the best strategy. If you read a bit on this in Google, you'll get to know more about it. But the whole idea is you are setting a range at the beginning of the month to play on theta depreciation.
How to build Nifty monthly strategy?
So again, it's the same answer, but if you were to build it yourself, you have to form a view. Basic knowledge of technicals is needed. But if only using an options data, it has to be seen, then you have to see the rollover numbers. You have to see how the FIs are positioned. And lastly, you have to see where the highest open interest stands in puts and calls, because that will give you a broad trading range as to where the support and resistance are defined by the option traders. And then accordingly, you can set the iron condor strategy, which works well in 7 out of 10 situations. And that is the way to approach the market if you are setting strategies for the month.
Thank you, Akshay.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.